Time on Capitol Hill. And the first thing I learned in Washington is you can't beat something with nothing. In other words, if you hate a policy or a program, you just hate it, you write op-eds, fine. You're not going to change it unless you bring something to replace it. So for all the criticisms of the dollar, and there are plenty of them, you're not going to dethrone the dollar as the leading global reserve currency unless you can show me what you're going to replace it with. And there's one and only one contender in the world today, which is gold. So that's a whole other conversation. I'm not saying we're going to be on a gold standard tomorrow.
It is, but it does, if we bring it full circle back to the book, a lot of what you talk about here, there's a line in here which is, you got $3 trillion of new Federal Reserve money and $4 trillion of deficit spending by Congress. However, they will not cure the depression. Money printing and big spending may help keep the lights on in the economy, but those policies should not be confused with stimulus. And I think your broader point here is around this idea of confidence. And confidence is this very, delicate thing to describe, that if you're building a house of cards, as I think we've seen reports that China is essentially just their internal printing press and all this. There's a lot of house of cards going on inside of China. How much that's insulated inside of China, how much of it leaks out, whatever. That's a whole other conversation. But is, unfortunately, the United States, have we put ourselves into that danger zone where, the house of cards is now just, there's so many cards in it that we're close to having that thing collapse, and it really comes down to confidence. And if you keep printing all this money, and you got what do we have now, like $26 trillion in deficit, the Fed has a $7.5 trillion balance sheet. At some point, do people start to lose faith in the dollar? And then maybe that accelerates your point here on gold.
Let's break that into two parts. Let's separate confidence, which is a big deal, and stimulus, which is also what I was talking about in the caption you read. As far as China's concerned, China's a house of cards. It's going to collapse. It's going to be ugly. Hard to say when, but probably sooner than later. And they know it. So we can. And they're not going to be a global reserve currency. So we can put China to one side, but China's a house of cards. Now, getting it back to the United States. So the first point, let's talk about stimulus first. So the Fed printed $4 trillion. Congress, we had $1 trillion, what are called baseline budget deficits going into the pandemic. So with no pandemic, we were going to have $1 trillion deficit in 2020 and 2021. Now, Congress put $3 trillion on top of that with rescue and bailout programs last March, April, and May. That was the CARES program, payroll protection plan, aid to hospitals, extended unemployment benefits, higher unemployment benefits, et cetera. I'm not saying any of those things were bad. It was needed to keep things from getting a lot worse. But we put $3 trillion on top of this. So there's $4 trillion for fiscal 2020. They just did $1 trillion last week. In the kind of final days of the Trump administration. So that's $5 trillion. And Biden has announced his plan. He's going to have a $2 trillion rescue bailout, so-called stimulus plan now. So that's $7 trillion plus the $1 trillion baseline for fiscal 2021. So there's $8 trillion in deficit spending in 2 fiscal years, $4 trillion of money printing by the Fed. Now, those are the numbers. That's not projections. That's baked in the pie. Just don't call it stimulus. It will have no stimulative effect. Does it, again, as I say, keep the lights on? Yes. Would some people keep their jobs last spring because their employer got payroll protection plans? Yes. Did other people benefit from increased unemployment benefits? Yes. Was a lot of that necessary because things were in such bad shape? Yes. So I'm not arguing that side of it, but it does not stimulate. It's not going to get us out of the depression. Let me be very specific as to why, because I don't make claims without backing it up. On the money supply, you can print all the money you want, but Milton Friedman was wrong, the monetarists are wrong, the Austrian school is wrong. Money printing does not cause inflation. What causes inflation is something called velocity, which is the turnover of money. The money has to be lent and spent. Banks have to be lenders. People and businesses have to be borrowers. You have to be spending it, get it in circulation, in other words, in order potentially to have some inflation. And that's the technical name for that is velocity. Velocity is dropping, sinking like a stone. By the way, it's been dropping since 1998. It dropped faster in the 2008 crisis. It's dropping faster today, but the trend has been very steeply down for the last 22 years. And so, nominal GDP, so the dollar value of all goods and services, leaving aside inflation, that's what we mean by nominal value. Nominal value of gross domestic product is money supply times velocity. How much money is there and how much does it turn over? Multiply one by the other, and that's your nominal GDP. And I remind people that $7 trillion times zero is zero. Meaning you can print the $7 trillion, but if you don't have any velocity, you don't have an economy. And so you can understand monetary policy is a desperate race between increasing money supply and declining velocity. One offsets the other so that you barely keep nominal GDP where it is. In fact, it's going to go down about 6 or 7% for 2020. We don't have those numbers yet. We're not getting back to 2019 levels of output. If you take 2019 as your baseline and then down in 2020, we're not getting back to 2019 levels till 2023 at the earliest. We're not getting back to 2019 levels of job creation, the number of people who have jobs until 2025 at the earliest. That's why I call it a depression, not a recession. Now flip over to fiscal policies. Like, hey, they're sending everybody $2,000 checks, and they are. The people are going to get those checks. And so the Wall Street, which usually gets things wrong. That's the first thing you got to know about Wall Street, because they don't really care about you. They care about rap fees and how they make money. So they're saying, all right, they're going to send out the $2,000 checks, and people are going to get those checks, and they're going to run right out. And they're going to buy a car, a refrigerator, paint the kitchen, whatever it may be. No, the first two things are true. They're going to spend the money, and they're going to borrow the money, and they're going to send people the checks. But when people get the checks, they're not spending it. What they're doing, they're saving it. They're either paying down debt, which is equivalent to savings, or they're putting the money in the bank, which is savings. And so certainly, if you lost your job, you're not going to take your friends out to dinner. You're going to throw the money in the bank or pay the rent. But even if you didn't lose your job, you look around, like maybe your spouse lost his job. Maybe your neighbor lost his job. Maybe you think you're next. Like you have a job, but you're worried you're going to get fired next week. So you save it. And the name for that, economists call that precautionary savings, or, plain English, it's saving for a rainy day, except it's raining everywhere. So they are going to send the checks out, but people aren't going to spend it. And that's the reason you're not going to get the stimulative effect. But you are going to increase the deficit, which gets back to this debt to GDP ratio. So take the total debt divided by GDP, and that's some ratio. The research is very convincing, very clear. A number of studies show this, that up to about 90%, so 90% debt to GDP, you get a little bit of something called a Keynesian multiplier, meaning you borrow $1, you spend $1, and you get $1.10 of GDP, or you get $1.05 of GDP. And it works maybe temporarily, but it works when people won't spend the money the government can. That's the idea. But when the debt to GDP ratio goes above 90%, that's what physicists call a critical threshold, or a phase transition. Now you're through the looking glass. Now the Keynesian multiplier drops below 1, meaning you borrow $1, you spend $1, but you only get 90 cents of GDP. But meanwhile, the debt went up $1. So what's happening to the debt to GDP ratio? This is going up dollar for dollar, but this is going up 90 cents on the dollar. So the ratio is getting worse. Guess what the US debt to GDP ratio is today? The answer is it's about 135%. So we're way past that 90% threshold. And by the way, who's in that club? I can tell you, Lebanon, Greece, and Italy. So there's your lunch table for four, the four super debtors league. And it just gets worse. And that ratio past 90% is a headwind to growth, because people look at it and like, hey, I don't have a PhD in economics, but I just don't like what I see. And people understand correctly, and this is the behavioral adaptation that policymakers on Wall Street do not understand. But the behavioral adaptations, people look at it and say, I don't know how this is going to end, but it's going to end. We're either going to have a default, or we're going to have something like hyperinflation to make the debt go away, or they're going to raise my taxes. Not sure which, maybe all of the above, but I have to save more money to meet my lifetime goals in the face of some bad outcome that's going to come out of this. That's the real world behavior, and economists know very little about the real world.